What is a variable interest rate for student loans, and is it a good thing or a bad thing? Here's a couple things that you should know. A variable interest rate for student loan purposes is set according to something called 1-month LIBOR, LIBOR. This is a measure of short-term interest rates in the economy. This is heavily influenced by what the Federal Reserve does in terms of the interest rates that they're setting in the economy, and the Federal Reserve has control over short-term interest rates. So in general, whenever the Federal Reserve lowers short-term interest rates, you can expect your variable rate interest to decrease. Whenever the Federal Reserve increases short-term interest rates, you could expect your student loan variable interest rates to increase. So right now, since the beginning of 2019, variable interest rates have fallen about 0.5%. So variable interest rates since the beginning of the year have gotten more attractive. Now, here's something that you need to think about. In the meantime, interest rates for the long-term bonds out there have decreased a ton. So what we've had is this thing called yield curve inversion. So that means that long-term interest rates for student loan refinancing are very low, and short-term interest rates have been relatively high. So because variable interest rates are set based off of short-term rates in the economy, that means variable interest rates right now have been rather unattractive compared to fixed interest rates. So that's why from the very beginning of 2019, I was telling everybody, just do fixed interest rates. You don't want to do variable interest rates right now because you're not getting compensated for taking that risk of an interest rate that goes up and down. So for example, in the beginning of the year, you might have only been able to get a 0.25% lower interest rate, in exchange for taking on that variable interest rate risk. And that's really not that much to get compensated for. But now we're starting to see things change a little bit in the economy. The Federal Reserve has cut interest rates multiple times. The variable interest rate, of course, has fallen because of that. And so if you look at long-term interest rates, you might be getting like a 4 to 5% for long-term rates, and you might be able to get maybe a 2% something rate for the shortest 5-year variable rate term. So is a variable interest rate good or bad? There's a couple uses of a variable interest rate. Let me just tell you the two. So one is you could think that you could make more investing than paying down your student loans, in which case you want to get the lowest interest rate possible. And a variable rate is generally below that fixed rate at that time that you refinanced. So some people might do a 15 or a 20-year variable rate because they believe that they can beat that rate of return by investing their money instead in the private markets. And having a variable rate with a long-term refinancing deal keeps your monthly payment rather low. Now, the other most popular reason to use variable interest rates is because you owe less than your income and you want to get out of debt very fast. So this is what my wife and I actually did. We chose a 5-year variable rate, and our interest rate started off at about 2.2%, and it rose till about 2.7%, so it did increase, but our fixed offer that we got was about a 3.2 fixed interest rate for a 5-year term. So even though our rate rose while we were paying it back, we ended up saving money by getting a lower interest rate by taking on that variable interest rate risk. The danger of that is if we were in a position where we could not afford to pay that loan off in only a couple years, then we would have taken the risk that interest rates in the economy might have spiked, and then we would not have been able to afford that payment, and we would have actually cost ourselves more money in interest than we would have gained by, taking that variable interest rate risk. So here's a great rule of thumb. If you can get a variable interest rate that's 1% lower than the fixed rate you're getting offered for the same loan term, and you owe less than what you earn, and you have a plentiful emergency fund in your bank account, then feel free to go ahead and take a variable interest rate risk. In that scenario, it will probably pay off. Just realize that it's something that you want to carefully consider because obviously a variable rate means interest rates could go up, and you just want to be able to pay down your loan very rapidly were that to happen. But there's nothing wrong with a variable interest rate. I think it's totally fine. Just make sure that you know what you're signing yourself up for. Any questions or comments, just leave them in the YouTube video below or in our blog post.